Misconception number 3, higher risk always leads to higher return. Now, we love talking about the risk-reward scenario, right? I mean, there is some truth to you can't get a lot of return if you take no risk, but it doesn't mean higher risk always leads to higher return.
The key word in what you said, Scott, is always.
Right.
Anytime there is always or never in some advice that somebody is giving you, it is very high probability that it is wrong.
And I think about cryptocurrency when I think about this because, it was kind of a fad for a minute there where people were just making insane returns and then it failed. There was over 2,000 companies that failed in just a short period of time, and you could lose everything. So risk is not all equal. The risk you take on from like a mutual fund versus an individual stock, those are different risks. And the risk level has to be dependent upon your timeline and your ability to tolerate that risk.
And there's always that shiny object out there. Crypto is just the latest one, but there's always something out there that somebody feels like, oh, this is it. This is the ticket. I found it. Look, you're on a journey searching for something you'll never find because there is no get-rich-quick scheme.
No.
There's a lot of schemes out there that will tell you can get rich quickly, but it doesn't work that way. What you want to do is you want to have a plan to get rich slowly and be able to accumulate wealth and have real financial independence, not just financial independence on paper like some of those crypto people had. Unless they cashed out at just the right time, that financial independence they thought they had slipped right through their fingers.
And that was highlighted in a study that we've got here in front of us too. In 1972, there was a study that talked about the low volatility anomaly. So the idea was economists concluded that over the long run, stock portfolios with lesser variance, so less up and down, still making progress but not quite as much up and down, actually experienced greater average returns than their riskier counterparts. So if you have those bigger dips versus just kind of a slow and steady wins the race approach, you may actually fall behind what you could have without those.
Yeah, we've got a graphic on this as well. Let's take a look at that real quickly. And basically what you see is that there is a sort of a happy point here. Around that 5-6 mark, 4-5-6 mark on the scale there is where you get the highest return and more moderate volatility. Now, clearly, as you go on lower volatility, your return goes down. But what is really interesting is the higher volatility portfolios actually have lesser return than some of the more moderate volatility portfolios when you look at this scale. And this is what really we do in the ready to retire process, Scott, is that we look to lower volatility over time because volatility is your friend when you are accumulating money in the market, when you're buying shares. The volatility drives the price down. You can buy more shares at that particular point in time. It works just the opposite in retirement because when the market goes down and you have higher volatility, then you have to sell more shares in order to generate the same amount of income that you're needing for retirement.
When you think about it, and you think about it in terms of finding that hot stock pick, that's kind of what we're talking about. Don't go after that. Don't go chasing after returns. Put it into a long-term strategy for financial independence. The difference here is if you want to buy some individual stocks, that's great. There's no problem with that. You can do that with sideline money, right? It's not too far removed from your casino money, let's be honest, because you don't have any control over it. And when you have money invested in one company, it's kind of like the elevator being held up with one cable, right? If that cable snaps, everybody on the elevator is going down fast. But in a diversified strategy, you've got several cables, probably 30, 40, maybe even 50 holding up an elevator. So if 1 or 2 or 5 of those snapped, you're still going to make it safely to your destination. That's the concept you have to think about is, yeah, I mean, there's nothing, that's fun picking stocks. Like, I mean, I've got a few individual stocks, right? But I'm not counting on that for retirement. I'm not counting on that for financial independence.
That's your fun money.
That's fun money. So the truth is it's not about picking the right single investment that's going to get you the greatest return. It's about a diversified approach that if volatility is managed properly can actually give you a better return than if you had gone with an individual investment vehicle.